I thought this was a trading video. This looks damn good. I like this. I like, what? Nah, man. Nah, bruh. Nah, man. I've been fooled too. We've all been fooled before with fake outs when it comes to risk levels. Support, resistance, we hear it all the time. We made videos discussing about risk levels and how important it is to kind of give some risk wiggle room and some not. But today we're gonna dive even deeper into that topic and share my screen and show you specific examples. So stay tuned and make sure you watch the entire video. I wanna take this time to say thank you to our sponsor, Cobra Trading. Cobra Trading is the go-to broker for day traders and short sellers. And I'm not the only one saying this. In fact, Benzinga awarded Cobra Trading as the go-to broker for short selling. They have a heavy focus on direct market access order routing, so you have the fastest execution. They have some of the best locate prices and availability. They also have amazing customer service. I've experienced many different brokers, and it's why I use them every single day and why I'm proud to have them as our sponsor. Sign up now by clicking the Be The Trader referral link below and earn 1 free month of software with Cobra and 25% off all commissions. Now let's get back to the show. So you know what support and resistance is. If you don't, go watch one of our videos when we discuss specifically what that is. But I want you to understand that support and resistance can be viewed in 2 to 3 ways. One of those ways as a solid wall. And what I mean by that is an area that does not breach. Now the odds of you finding that are not as high as your odds are of finding the other type. And that is kind of like a paper area of support. And what do I mean by that? I mean that if you have a support level that is as thin as paper, and you're using this as your risk, the odds are you're gonna get faked out because it doesn't take much to pierce through this thin piece of paper, right? Through that thin level. And there's some levels that are more like this. Whenever they get hit, they give a little bit. And they don't break, they just give a little bit. It's more like a zone, and then they bounce right back. You've seen it, the candle where it just wicks. And then there are some that just break right through it, right? Just break right through it. And when that happens, you get faked out probably, right? Because it just breaks, rips, and looks like it's over. But what happens next? This is a little dirty. It shoots it right back through the hole, comes all the way back. And you're like, well, isn't that the same as the trampoline, the little concave? It's not, because it might hold under that level for just a couple of minutes, whereas the other one just wicks. This is frustrating to all traders because you're taught by Google and just looking at all the gurus who like sell all these courses that like, here's your risk level, that's what I'm risking. But they don't get into detail and explain why they held against the risk in that occasion and why in another occasion they just got out because it barely breached it. Or in some occasions they get out before it breaks. And you try, I know, you've asked the question to them, why did you do that? I thought your risk was Y. But they don't reply, do they? Most don't. Some do, and some are great teachers, but most don't, and I want to help you with that. As I mentioned earlier, not all levels are equal. Think about these ice skaters. I don't know if you've heard of them. They go ice skating on random lakes, not lakes that are open for ice skating, but lakes that are just freezing over. They'll just go, and I've called them extreme ice skaters, and they just go and skate on this random lake, and they don't know what areas of the ice are thicker than the others. But how they recognize that is through listening. While they're skating, they can hear the cracking of the ice. And when they hear certain noises, they avoid those areas. They're thinking, hey, this part of the ice is very thin, so I'm not gonna put my weight over that because I may not make it. As a trader, every risk level is different. Not all risk levels are the same. Some you can skate on and not worry about anything, while others, you need to know that's a really, really, really thin, weak risk level. And you might need to anticipate it may not hold properly. So how do you determine which risk level is thin and which risk level is actually solid? Well, I'm going to show you that here in a minute by sharing my screen and showing you all different types of examples, how I would use this risk level over another, how I'm going to give room and not room to another. I'm going to give you details on that, but I need to explain this very thoroughly so you can get an understanding of how you need to think before I just show you examples. Some traders will see multiple levels, and what they do is they size in to each level because they don't know which level is going to be the one that supports, because you've seen it. You've seen charts where you're like, man, there's like 3 support areas. Which one do I use to risk? Which one do I buy at? But then you'll see the pro traders out there that you follow and they're buying at each level. What are they doing? They're sizing in appropriately. And they may not even size in big size at all until their level supports. And when that happens, then they smash it with all their size because the level has shown that it's going to hold. And no, we don't know that it's actually going to hold. Trading is random. We all know that. If you don't understand that, you need to check out Mark Douglas, Trading in the Zone. He really does a great job diving into that. But trading is random, no matter if you have a system, no matter if you have odds, it doesn't matter. But just know this is how they're thinking. They see 3 levels. I'm gonna risk a little bit at each level until one shows proof that it's the actual key level that should hold, and then we'll hit it with our size. It's kind of like when you're playing with your dog. I don't know if you have a dog, but you know how some days you can get really close to your dog and not have to worry about him biting your nose or licking your face? And then there's some days you can't even get this close without him jumping on you because he's all this excitement. Like, you're kind of gauging the risk before you commit, before you just sit there and with confidence. Otherwise, you're kind of just like, okay, well, how close can I get? That's what you're doing first. It's the same thing. You're taking your time. Wait for it to give you some sort of sign that this is the boundary. That's the line in the sand. As I mentioned earlier, randomness in trading, that's real. You never know which ones are gonna work. You just can place your trade once you have identified a risk level and a good setup. Let's get into the examples. Now I want to show you some different examples of charts here that have different key levels of resistance and support, and why some levels I might prefer over others. In this example on Apple, you'll see it's a breakout above this blue line here of 166.50. And this is the pre-market action. It breaks out and goes straight up to 169. Now when this happens, I'm excited because it's a breakout. It's starting to work. But the question is, if you're watching this, you're probably wondering, where do you get in? Where is the area of resistance that now becomes support? Or where are the other areas of support that I want to buy at? Here's a couple of things I'm looking at. If we zoom in here, we'll go to a 5-minute chart. You'll see when it breaks out pre-market and just squeezes all the way up to 169. Now, the old me, and sometimes if I'm impatient, I will buy at the first pullback near the breakout, which is yesterday's highs. It pulls back to yesterday's resistance, which should act as support. But why does it not act as support in this case? This is, of course, my opinion, but when a stock just moves straight up, this stock moves straight up. Like, we got to always ask ourselves the questions. Where did this stock come from? If you ask that question, it came from 166 all the way up to 169. So it did a $3 move right near the open. That is a very significant move. Stocks usually, this is a general rule, they don't just usually move straight up, right? They usually move up, consolidate, move up, consolidate. If they move straight up, then my personal general thought is they're going to move straight back down the same way. So when I see a stock just move straight up, yes, in some cases, if this just moved up here, consolidated for a while, and then broke out, and then pulled back to this level of 167.35, then I may have bought there, right? That might be a good opportunity to buy. But because of how this stock acted, how it came from 166 to straight up without any consolidation, without any breathing, right? It didn't take a minute to breathe. I personally believe that it should pull back more. And so the first level is not as important. And this is why trading is difficult. There is no one rule fits all. It's an art and a science. but I'd be willing to bet it's more of an art. When it pulls back to the main level of the breakout, you would think it should go, right? You would think that. And I wouldn't blame you. Like, that's a good area of interest, right? You can have an order there. However, the main area of interest will make this line red, is the red line. And the reason that's the main area of interest is because that's where the move started. It literally just started from here and just skyrocketed. When that happens without consolidation, that's where I want to base my risk off of. Now, here's something else you got to wonder. If you just risk this line, you might get wicked out here and get stopped. That's frustrating. If that happens, it's trading. That's part of trading. If that happens to you, you got to be willing to get back in. However, some stocks, you want to give it some room, especially near the open. Now, this isn't near the open. This is at 11:15 market time. So I may not give it that much room and I may get stopped out, but you have to know that some stocks aren't super clean and it may test it. And if that's the case, you got to make two decisions. Either A, I'm going to give this stock some room because this support level, even though this is the main level, there wasn't a lot of volume here. So it could be a zone, right? It could be an area of interest rather than just a key level. If this chart had massive volume and was holding this area really nicely, then I would have a tighter stop and be okay. But you need to think about this going in. Either A, you have a tight stop and get stopped out and then get back in, or B, you have wiggle room and you build that into your plan. And in this case, you wouldn't have gotten stopped out. But this is a good example of how not every support zone is equal, right? You got to figure out, where did it come from? Let's go into another example. This is Tesla. The reason I want to go over Tesla is because you'll see this red line here, diagonal line. It is very clear that on the 1 hour, this is a 1 hour chart, there's a downtrend line here and it's obeying this line very nicely. And when I see that, that's something that I want to acknowledge. We're in a downtrend on the big picture. That's important. And then you'll see some resistance right here at this area, this 885, which is why I drew my red horizontal line of resistance. But then I also have this blue resistance line that's above this wick right here. But which level is important? In this case, for me, if you look at this, when we zoom in, and let's go to the 10-minute, you'll see that these lines intersect. I've talked about this a lot in my channel, and it's the whole idea of confluence. When multiple things line up, we got the big picture, right? We have resistance from a diagonal, we have resistance from a horizontal. Then that may be the key area of interest for me where I want to focus in on there. So you can play this in many ways, either use this area or you can use the blue as well as a guide. You can say, I'm going to start in here and then add as it gets to here and stop above it. But again, Tesla is a stock that moves very rapidly, and near the open, which is where we're at, it can be very emotional trading. So I give Tesla extra wiggle room because I've traded Tesla multiple times this year and last year, and every stock moves different. And you'll start to learn stocks. This is why I talk about in another video how it's important when you're new to pick a couple of stocks and just watch them, because you'll notice how they each react different to key levels, how some don't really care about the level and will wick way past it and still respect it, whereas some will never even touch it because they respect it so much. But you won't know that until you start to look at mini charts, and as a new trader, really just stick with a couple of tickers to kind of get familiar with how they react. Another example I want to go into is Mara. This stock, you can see on the hourly chart, there's a downtrend line here, right? You see how it hits these key pivot areas. Once it hits these areas, I'm thinking it could possibly be a short. So if you're thinking that, and we zoom in to, let's say, the 10-minute, and feel free to rewind this video and pause so that way you can see. This chart has multiple levels of resistance. You can easily see that, and I made them different colors. So you can see here that we have a white, a yellow, a red, and a blue. And this is the day we're going to be trading it. And we're watching it pre-market, because pre-market, we're developing our plan, right? And so because of that, we're going to be looking at these levels, because I'm going to be like, where are the levels of resistance? You can see it stops at this line. It stops here. It stops here, as well as here. But then the question is, which one do I respect? Which one am I going to actually acknowledge and use as my risk? Here's a general rule of thumb for me that I kind of think about. If the resistance line is super close, I may not respect that line as much. If the stock is starting right near the white and yellow line, I may put a starter on, but I'm not going to really trust that line, because again, it's near the open. Time of day is important. There's a lot of emotions at the open. It's the most volume typically in the day. So with a lot of emotions, a lot of traders get emotional. They start to make random decisions. You get a lot of whiplash, and those levels tend to be ignored, in my opinion. Now, when that happens, I may look at the red level and blue level, because they're a little bit further away. Now, here's the thing. I may use both of these levels as guides, and I may start in maybe at the yellow, add a little more at the red, and have a bigger position at the blue. But if it doesn't get to the blue and it's such a show me weakness, like in this case, this wick, and this is a 10-minute chart, then I may be inclined to use the red level above it with the wick as my risk and start to hit in with more size. If you don't feel comfortable though, you can always use wide risk, and that's okay, because you got to ask yourself the question, where am I completely wrong and it's no longer a short? Well, you could build a case that's really above 28 or above 27.50, depending on how the chart plays out over time. But in the moment, you don't know what's going to happen. You don't know that it's going to tank. So you just got to make a judgment call, and you got to be willing to hold to your risk level, or make two plans and say, I'm going to get in here, cut it, and then re-get in here. That is something that can be very hard for a lot of traders, because we just want black and white. We just want, hey, it has to stop here. In some cases, it does. There's some cases that it does. But there's a lot of cases that you got to give it some room, especially at the open, because that's where all the emotions are. So I'm hoping you understand that, and you're getting a better idea of which levels are more important than others, how you should use them as a guide, how some can be strict and you have to use that level and I don't want to breach above it, and how some you got to give it some room. Now, I want to give you an example of how strict you need to be. Once the stock starts to move, let's go to the 5-minute. Once the stock starts to move down in your favor, let's go ahead and delete these resistance lines because they don't matter to me anymore. At this moment, I am now confident that this is my risk level. So this is the resistance that actually is important. So at this point, I don't care if it wicks above it, I'm getting out, because at this point in time of day, we're getting further into the day. Now we're 30 minutes in. I'm not going to be comfortable holding this against that risk level anymore. So I'm going to be more strict. However, there are some stocks where they're so beautiful on the chart. And let me find one for you. Here's a great one, Sophie. This chart was so beautiful. If you look at this, such a beautiful trend line. If we zoom in here, really, really beautiful trend line. And this is what I mean by how it just respected it every time I bounced at it, right? If this stock has never broken this level before, it constantly tests it, and let's just say this is multiple days, and then it's never broken this resistance ever, and it's always tested it, right? I don't care if I get in on this breakdown. I don't care if it wicks above 1312. I am getting out. I don't even care if it's a fake out, because this stock has proven that it respects its levels so well that I am not going to give it any room.